All right, let's get rolling. Wow, what a surprising month we've had since our last webinar in January. We rolled into the first quarter expecting a continuation of the fourth quarter, and we've certainly not seen it. In the third and fourth quarter, we had really restricted demand, few buyers, also not many sellers, but the number of transactions was falling dramatically. We could really see the market had frozen cold. And pretty much after the start of the new year, we saw a surprising turnaround. And that turnaround is really on the buyer side. We've seen people eager to transact, to buy homes. And as a result, we've had inventory falling. It's a surprising trend because interest rates, while they fell for a lot of January, didn't fall that far. So what is it that's keeping folks engaged in this housing market? We're going to talk about a lot of those things. Before I dive into that today, I'll point out that we have several hundred folks on the call today, probably have 500, 600, 700 folks on the call today. We have in the chat box, we have Lael and Jeff from the Altos team in the chat. So as I'm talking, and if you have questions about the data, about Altos, about how we do our products and things, feel free to drop your questions in the chat box, and the team will try to keep up with those as we're going along. We will also, if I mention a link or a resource that you want to go download, those links will be posted in the chat. So Lael and Jeff from the Altos team are in the chat, and they will make sure that you get those links so you can click through and download if I have a reference. So use the chat as we're going along. It's really great. I love to hear where folks are from. It's really neat that we have so many folks on these calls each month and from all over. So it's exciting that we have some good reach. Altos Research tracks every home for sale in the country every week. We look at all the pricing, all the supply and demand, all the changes in that data, and we bubble it up and we make it available to you before you see it in the traditional channels. And what we're going to do in this webinar is look at the data as of right now, what we can already see we're halfway through the first quarter, and how much influence that has on the whole 2023 housing market. In particular, we're going to look at some of the things about why demand has been so surprisingly strong and what that means, how that's playing out in the spring data. We're looking at mortgage rates, and there are risks to the surprisingly current bullish trend that we're seeing in the data. So does that change later in the year, and how might it change later in the year? We of course spend time with inventory, where available inventory is now, and then our forecast for over the year. And also we've got a lot of leading indicators for home prices. Are prices going up? Are they going down? What's happening with prices? What can we see in the data already? We always like to try to frame the conversation about how you can talk to buyers and sellers about the data, whether you're a realtor or a loan officer, or you're an investor, or other person with exposure to the U.S. real estate market. We have all types on these calls, big investors, small investors. People need to understand what's happening in the market right now. And the fact is, the market is probably very different than what most people think is happening. If you don't pay attention to the Altos data every week, you might think that the real estate market is tanking hard. You might be reading the headlines from July and August and September and October and thinking that the real estate market is tanking hard, when the data actually shows that it hasn't been. We have a real turnaround in the bottom of the market, and we can see how that is playing out. And so really that's what we try to do here is how do you communicate what's actually happening in the data right now to the buyers and sellers, to the other folks in the market. And of course, we try to spend a lot of time with the local markets. Local markets are behaving very differently. So we'll spend the latter half of the webinar in local markets, and we'll dive in and look at some of the Altos reports for those. All right. So use the chat, ask the questions along the way, and let's get rolling. Before I actually dive into the data, I always like to share that at Altos, we have created a free ebook that is how to use market data in your real estate business. It's how to communicate with the data. It's scripts and ideas, strategies for helping inform clients. And, right now, everybody needs to know what's going on. So some of us, we created this so that you can get ideas how to use the data that we're talking about in the webinar, that we talk about in the Altos reports, so that you can be on top of it when people ask you questions. So there's a link in the chat that I'm sure Lael has posted for going to download that ebook. If you haven't already grabbed that ebook, go get it now, because it'll really help you communicate with market data to your buyers and sellers. All right, let's start with mortgage rates. Really, the mortgage rates were the story of last year, spiking from 3% early in the year all the way to 7.5% in October, before drifting back down lower. In this chart, each of the colors, that's each a year. And so you can see the pattern over the years, and how in the last 2019, 2021, kept dropping to record low levels, and then 22 spiked dramatically. We saw both that first spike in the first half of the year, people stopped, and then in that middle of last year, the rates drifted back down from like 6 closer to 5, and people started buying again in October. In the second week of September, second week of September, rates went from 5.5 to 6.5 to 7.5%, and it stopped activity cold for the second half of the year. What was really fascinating is that as rates drifted back down to around 6 around the new year, we actually saw activity again. I've been saying that 5.5% feels like a threshold for affordability, and and because that's what we saw in that late summer last year. It spiked up to 6 and then back down under closer to 5, and people started transacting again. This spring, it feels like that threshold's a little higher, like around 6%. People were taking advantage of that, and it could be that we know that there are buy-down programs, rate buy-down programs. There are temporary rates where you're still qualifying to buy at the 6.5% rate, but you get a 1 or 2 years at 5.5%. Or lower. And so hoping that you can refinance in the future and get a better deal. So people who are buying now know that if rates go down in the future, they can refinance. If they go up in the future, they've got the best deal that they can get. So like that seems to be the psychology that folks are using, buyers have been using up through this week. What's interesting is in the last week, 2 weeks, we've had a string of very strong economic data. The retail sales are up. The employment stays really, really well employed. Unemployment is very low. We have inflation came in, the inflation numbers came in down, but not down as quickly as it's been falling recently. All these things point to a very robust economy right now, and therefore mortgage rates have reacted higher. As of right now, mortgage rates are like 6.75%. That's the highest they've been since like November. And it remains to be seen how sensitive those buyers that we've had right up through till today, how sensitive are they to that move? That's a big move, 6% 2 weeks ago to 6.75% today. And does it put a damper on those spring buyers. We will start to see that play out if the rates stay up here for the next few weeks. It'll take a couple of weeks before you start to see it in the Altos data, but I'll show you where we did see it immediately in that in that September 5th date when rates spiked the last time. And do they go over 7 now? Do they go back down under 5? For a few days there, we were looking like rates were going to drift back under 5%. So those are the risks, and it's really a risk for the rest of the year. We've seen the activity already for the start of the year as rates were around 6. Now, if rates stay around 7, it seems likely that will put affordability out of reach for a significant number of buyers. You'll have cooling of buyers, and we'll see inventory build towards the rest of the year. I'm not an interest rate predictor. I don't know where rates go from here. So all we can do is watch what happens very quickly to demand when rates change. It's a risk. It is a risk for the rest of the year. Like, do we continue this momentum that we've seen? And in some ways, you can understand that the Federal Reserve is looking at housing, and a super strong housing market, a surprisingly strong housing market, means that the Fed needs to keep rates higher longer because the Fed is trying to slow the overheating economy so that inflation comes back into check. And so one of the signals they may look for is, if housing is strong, it's one of the things that would keep mortgage rates higher to necessarily slow that down. These are risks that we face. I don't know how to predict these risks, but we're going to measure the consumer behavior as quickly as we can. The real story since January 1 has been inventory. Available inventory of single-family homes in the U.S. right now is down 3% this week to 443,000 homes. And you can see at the far right end of this chart, there's a steep drop-off, and it's actually very unusual for inventory to be falling this dramatically week over week, this late in the year. So inventory typically bottoms in the first few weeks of January, typically meaning the last decade, and bounces around. So some up weeks, some down weeks, but January tends to move sideways. And then by February, by this time in February, it's ticking up, and then the slope starts to curve up. And you can see the curve each year here. In 2019, there were 814,000 single-family homes on the market. And you can see that date, this week in 2019, was that absolute lowest point and was just about to start climbing higher. During the pandemic years, you can see 21 and 22, February, inventory is dropping quickly in February. And so what's happening, what it looks like right now is demand looks like the curve of 21 and 22, the pandemic years. It doesn't look like pre-pandemic. It doesn't look like it's getting back to normal. And I expected in December and November, like that we would start to have a much more normal seasonal curve. And really what we find is that after the New Year's, buyers have moved in more quickly than they used to. Sellers have not. And the sellers, of course, have their 3% mortgages, and they are very reluctant to sell if they don't have to. And so what we see is we have more buyer activity and less seller activity, and inventory is falling pretty rapidly. Now, I'm going to be very curious to see what happens if rates stay at 6.5%, 6 to 7% in next week and the week after, because you can see at the last little hump there, the summer peak of inventory last year, you can see it curved over and then started climbing again, and inventory started climbing again in September when rates spiked from 5.5 to 6.5 to 7.5%. You can see that second little jump in the year. And so we're going to see how quickly inventory responds to that right now, because as of this week, mortgage rates, the average 30-year fixed mortgage rate is 6.75%. That's starting to get up there again. And people definitely feel that affordability. So that's the supply story nationally. What's interesting is it would be wrong to characterize it as like a lot of demand. We have some demand. We have more demand than we did in the fourth quarter, and we have significantly fewer supply, fewer new listings each week, lower total new supply. In this chart, each bar is a week, and the total height of the bar is the total number of new listings that came out that week, that got listed, they came to market. The light portion of the bar are the immediate sales. So now, they get listed and they get an offer right away and they go into contract. They don't even stay on the market for more than a day or two. Those are what we call the immediate sales. And you can see during the pandemic, the last couple of years here, the immediate sales was a big portion of every new listing. We had the bidding wars and we had things going super quickly. You could see that portion, the light portion of the bar, really big. It's significantly smaller now, which shows you that obviously we don't have the ravenous demand that we had a year ago, but it is, that light portion is growing each week. It has been growing as we've had more immediate salespeople taking advantage of the right listings at the right time, at the right price. So this week, there were 58,000 new listings, and this same week a year ago is 67,000. So 13% fewer new listings this week than we had a year ago. Fewer of them are going into sales immediately, but that's significantly fewer sellers than we've had. And many of your buyers and sellers, if they have a particularly bearish view on housing, if they have been reading the headlines that says housing prices are crashing and have the real negative headlines, if they have that view, they may be assuming that there is some surge of new inventory coming. Maybe it's from panicky sellers who need to sell before home prices fall, or maybe it's from investors who no longer can get their rent, or short-term Airbnb folks who need to sell. And so what this data shows us is that there is or maybe it's like people losing their jobs and need to sell. But what the data shows us is that essentially none of those groups are selling in bulk at all yet. So we actually have fewer of them. And until we actually see evidence of those are merely stories that might happen in the future. There's something to pay attention to. If the economy, hits a big recession, will we start to see more listings? Maybe. If rates start climbing higher above 7, will we start to see more listings? Probably. So those are things that we can look for. But as of right now, there is no evidence of any of those happening in any big wave and any volume at all. So that's really the new supply, the message. And if you have a seller who's afraid to sell, that's the key message, is that you have really low competition right now, and it's a good time to maybe list your home. Let's look at then how that plays out in the inventory forecast. We started the year expecting to end 2023 around 700,000 single-family homes on the market at the end of the year. And you can see the dotted line here. So each line here is a year, and the dotted line here finally moving back up closer to normal. But as we have been each week, the actual inventory is coming in lower than the model expected. And therefore, the forecast for the year is ramping down each week. It's now looking like it's closer to 600,000 single-family homes on the market. It seems unlikely that we're going to return, back to the normal levels. The normal levels being 800, 900,000, 1 million homes on the market. A few weeks ago, it seemed like we were likely to get there, but it does not seem like that likely this year. And this curve will assume, the dotted line here assumes that rates are going to stay in the 6s, close to 7. If they go significantly above 7, this could creep up a little bit. Or if a recession hits hard, you could start seeing that climb up more. On the other hand, if rates are drifting back towards 6 most of the year, you could see this curve flatten out, and we end under 600,000 homes for the year. And still, that would be essentially a dramatic shortage of homes for sale basically around the country. And I'm going to show you a few of the local markets of where those differ. Some local markets are back to pre-pandemic, but still not normal levels of inventory. So let's look at prices. The median price of single-family homes in the U.S. is $418,200 right now. That's the dark red line, and you can see how home prices climb each year. There are two things to note about this chart. One is that while we have seasonal increase in home prices, it's not very steep. And last year and the year before, that January, February, March increase in home prices very steep, and because there was a ton of demand and restricted supply. And so that is what that's showing us, is that year over year, we are leading to essentially flat home price gains, essentially 0% home price gains. There are no signals in the data, despite the fact that we have increasing demand. We have some of those immediate sales are kicking up, but we've noticed that anecdotally, we've noticed that most of the multiple offer scenarios sounds like they're coming in around asking rather than like bidding war above asking. And so it's so different price restrictions than the market had when rates were at 3%. The other thing to notice here is the light red line. So the median price of the new listings is $389,900. So that's the homes that got listed for sale this week. And what we can see is that since January, it's kind of bouncing sideways. And that's what that's a notable change, where different from the last few years, most of the time in January and February and March, the price of the new listings climbs each week. The best new inventory gets listed. The pricing is good. We're anticipating the biggest demand for the spring. And so each of those, you can tell the future transaction prices based on the steepness of that light red line. And so you can see last year it was super steep. It actually jumped above the dark red line. And this year it's kind of going sideways. And that's another signal that there's no really upward pressure on home prices for this year. It means that these are homes that get listed now. Maybe they take an offer in March, it closes in April or May, and then those get reported in June or July, like that time frame. And you can see the listings right now and where they're getting priced. And people are you price new listings based on what's happened down the street. Are there people at the open home? Was there multiple offers? We have all this signal. And so we see a lot of that shows up first in the price of the new listings. And here's what's interesting about that price of the new listings. If we take that same light red line and we look at the year span. So each line here is a year of those price of new listings. You can see how each year home prices climb. You can see that in 2020, we started, that's the yellow line, we started right about the same as the year before, 2019. And 2019 was it was pretty close to flat in home price appreciation. And then in March, April, May, there was a dip in 2020. The new listings at the first 5-6 weeks of the pandemic were below the year before. And then in May, that's when they started climbing dramatically and stayed high through the end of the year. So the yellow line climbs away from the blue line. And you could really see just those 5 weeks of the first 5 weeks of the pandemic, that's when people had to price at a discount. But beyond that, they could see the demand was happening, and that prices marched up. Then 2021 was higher, 2022 was higher than that. We saw all those price gains in all the measures. But now look at the dark red line, 2023 is at the same price as it was last year. So these are the new listings going in at exactly the same price as they were last year at this time. We've lost that entire gain. And so nationally, this is what we're looking at for the year. It's why you can see essentially 0% home price gains year over year. And it'll be really fascinating to see if 23 the dark red line goes under the light red line later in the year, and we'll see how that plays out. But as of right now, we can see that generally we already know that 2023 will be essentially flat in pricing year over year. So now let's switch to the pendings. The pendings are great because these are the first proxy for the sales that are going to happen. The house is on the market. As soon as it takes an offer, it goes pending, and then it's in contract for 4 or 6 weeks, or sometimes more than that, before the transaction happens. And so then the traditional housing data is going to be, using the sales data, and so significantly lagging what we're seeing here. The things that we can see here, so 291,000 single-family homes are in contract as of right now. That is significantly fewer than last year. So the bar here, each bar is a week, and the light part of the bar are the new pendings this week, and the total height are all the ones that are in pending. So you can see last year the January numbers were significantly higher. What's really interesting is we've had good gains, pending gains each week since the beginning of the year. And when we started the year, we were 30% fewer homes pending because the fourth quarter was so cold. There were way fewer homes going into contract and way fewer homes in contract. So we had 30% fewer. Now, because pendings are climbing back, we have only 23% fewer. So that's we're closing that sales gap that widened way up in the fourth quarter. And you can see it as the light portion of the bar grows. Those are new pendings each week. And so you can see how we're catching up in terms of the number of sales. Still a lot fewer than that crazy boom time last year, but improving. And that was a surprising notion. Who would have predicted that would be coming back so clearly? Now, interestingly, the new pendings, the light portion of the far left bar, is only 9% smaller than last year at this time. So we had 30% fewer in pending contract. Now we're 23% fewer. And this week it's only 9% fewer. Like, you can really see that the sales rate's starting to normalize and climb back up. We're still going to finish the year with significantly fewer homes transactions done, but we can see real improvement over the crazy apocalyptic fourth quarter that we had, third and fourth quarter. And if we look at the prices of those homes in contract, the median price of the pendings, these were the final ask price. It does not include bidding wars and things. These are the final ask price of the homes that are in contract, is at $368,800. That's exactly where the pendings were last year at this time. And again, it's another signal that shows us flat year over year home price changes for 2023. It's on the same curve as it was last year. And so that climbs this season in the second quarter and peaks in May, at the end of May, because that's when the peak of the home buying season happens, and then starts to seasonally roll back down for the end of the year. But it's a signal that we can see year-over-year gains are essentially flat for 2023. If, for example, the market cooled dramatically like it did last year, second half of the year, if we get another one of those, what if mortgage rates spike to 8% or something? Then you'll see the pendings price also tick down below last year. And that will mean we'll be revising our forecast for the home prices for the year. You could see us in a way we'll show it here and how we'd be revising that down. So here's the other indicator that we like to share a lot. It's super meaningful. This is the median. These are the percentage of homes on the market that have taken a price cut since their original list price in the last 90, 120 days. And the normal band, I've got a bunch of years here. You can see that band in the normal. Normally it's around 30 to 33% of the homes on the market take a price cut before they sell. The last 2 years, we're at record lows because even though some people overpriced their homes to test the market, they got those offers and they didn't have to do a price cut. And then all of a sudden, you can see in the second week of March last year, the light red line starts to tick up from the tan line, and then start climbing really dramatically. That was the market cooling, and we can see it in the price reductions data very quickly, very abruptly. And then we ended 2022 with a 40% of the market, 43% of the market, I think, is where we topped off at. And that's a pretty bearish signal. We could see that we knew that 43% of the homes had to take a price cut. That's because buyers stopped cold, and therefore prices were coming down. What we see now is each week, fewer of the homes on the market take a price cut. Some of the ones that had now get offers and sell. New ones come on. We have new inventory coming on, fresh inventory for the start of the year. And so now we're down to 32.2% of the homes have had a price cut. It's a nicely steep, you can see the line is steeper down than the blue and the yellow and all these other lines. We're getting closer to normal as the demand of the spring has kicked up surprisingly fast. I don't expect it to get back down there. We still have relatively light demand. We still have affordability challenges with rates here, but it was really surprising. And it forecasts that we don't have dramatically falling home prices from here. We have normal levels of price cuts. We have normal levels of demand. We have it relative to supply. So people are buying what's there at the prices that are there. And so that means that transaction prices that happen in the future don't have a lot of signal that they're going down from here. We can see in the light red line, that's the curve from last year, climbed all the way dramatically higher. We could see the market slowing very quickly. And then in September, that second week of September, when rates jumped from 5.5% to 6.5% to 7.5%, you can see there's another jump in the price reductions. We can see there's a little spot right in the middle here where price reductions had plateaued, and then rates jumped and they kicked back in. And so that's what we're going to watch for this year. Does this curve slow down and start climbing if rates stay over 7%, for example, or jump back over 7% and stay there? The economy is super strong, and these are the things that the result in mortgage rates because the economy has been really on fire. So that's price reductions. What I would like to do is the local view of price reductions so that we can look at the metros. And this is the Altos Advanced Analytics dashboard. And I have a rank of the 50 metros that have the most price reductions. What we can see is Phoenix, Tampa, Austin. These are the markets that were the hottest during the pandemic, and they cooled the fastest. Phoenix and Austin, you can see were 60%. 63% of the homes on the market in Phoenix in November had a price cut. That's easing back down 49%, getting closer to normal. Not a hot market, but closer to normal. The thing that I've noticed in the last few weeks is Boise, what used to be at the top of this chart, of this rank chart in our webinars, at 65, 66% in November. Boise's falling back down, meaning there's some turnover happening there in Boise. People are buying those homes. And the Florida markets are starting to dominate the top of the price reduction. So the Florida markets didn't get as cold as the Western US did this last fall, but they are now, they're picking up less quickly than the Western US market. So it's really noticeable. You can see Tampa, Lakeland, Sarasota, Palm Bay. You can see them, Orlando, Jacksonville, all of those are starting to really dominate the price reductions market. We're going to come back to the local markets in just one sec, but I will do a little more on the national data, and then we'll take the days on market is up at about 77 days. It's probably peaked for the year nationally. It's still lower than it was, during pre-pandemic times, 3 months or 3.5 months, but significantly higher, obviously, than last year and even the beginning of the pandemic as well. So, but probably peak for the year, and then we'll start ticking down in the second half of the year as inventory, the latest inventory is on, and we go through our cycle through the end of the year. And then finally, let's do rents. The median rent for single family homes is up about 5% year over year. So it has receded back down. This is important for monitoring inflation, future inflation numbers. Rates are not continuing to inflate. Rents are not continuing to inflate. So that means that we'll have the year over year gains will start to bake out of the inflation numbers over the next few months. And so that will allow the CPI, the CPI to start coming down. There's a lag between the time the CPI, that inflation headline, reports rents and the time that it actually rents happen. It's like a year lag. So we will still see declining influence on inflation from rents for another year still to go. But the good news on that side is, like, it looks stable. Rents aren't falling through the floor. They've been about flat. Single family home rents, 2190 is the median rent across the country for single family houses right now. Okay, as I mentioned, Altos has published a free ebook so that you can talk about the data the way I talk about it. You can understand how to communicate these trends with your clients, your buyers and sellers right now, your investors, people who may have a very different view of what's happening in the market. A lot of people around the country still think the housing market is tanking. And it's the fact of the matter is, it's not tanking. It's a lot lower than it was. It was slower than it was last year at this time, but last year was the anomaly. We can see the numbers starting to tick up. We can see price reduction starting to tick down. We can also see that there isn't any pressure for price appreciation this year. Like, those are real things that your buyers and sellers need to know. And use the ebook. You can go download it now. There's a link in the chat. You can go download that ebook now to learn how to talk about the data with your clients right now. And Lael and Jeff will post links to that in the chat. All right, let's go to, I want to share some local markets. Let's go do some local markets. In the national report, this is the Altos report. And in the national report, this is again the national data, I want to point out the quartiles. Altos in every report does 4 price range segments. The high end of the market may be behaving differently from the low end of the market. And what we can see, I mentioned that 77 days is the median days on market right now. We can see that things under 200K are moving more quickly, and the $1 million homes are moving much more slowly. You can do this in your local markets. These are also on bigger land, they're bigger homes. You can see these are newer construction versus old ones that are under 200,000. That's what you can do in every local market. And by the way, while I'll give you a quick tour of the Altos system, in the Altos system, when you subscribe to Altos, you have all of your local reports here. This is mine. I have them for all the country, the whole country. But we can see who's opening them, which of my clients are opening them, and which one, and how many are being opened. We can share our zip code level or city level. We can do it at the county or regional or state level. I can look at our contacts and we can see the contacts, who's downloaded the reports, which ones are new, who's viewing my reports. I know exactly who to call. And we have our email campaigns. And what Altos does is automatically sets out the email campaigns for you to your clients so that they get the data every week. All right, let's dive into that's a quick tour of the Altos system. You can go to altosresearch.com. You can book that free consult with our team. If I don't get to your local market today, book that free consult with our team so that you can look at your local markets and see how to use the Altos system with your buyers and sellers right now. I have Baltimore open. Baltimore was an interesting one to look at. In the East and the Northeast and the Mid-Atlantic, the Midwest, inventory levels, the inventory chart up here for Baltimore, our inventory levels are essentially at their pandemic lows. We have crisis few homes available on the market. You can see just prior to the pandemic started in Baltimore, we had 3,800, 3,900 single family, 4,000 single family homes on the market, and we have 1,500 right now. So anybody who thinks there's some big flood of inventory or new construction coming or something happening, we can point out that we in fact have very few homes for sale. And as a result, the market action index is ticking up. It's in the seller's market because there's just very few homes available. So if you're a seller, if you have sellers in this area, they should know that this is a real opportunity for them, even though it's not last year at this time. Like, it's a real opportunity for them. We can also look at the price range segments. The $1 million homes in the Baltimore metro taking 3 months, but anything under $500,000 is significantly faster than that. And so that shows us where the data, that shows us where the demand is. I have Columbus, Ohio open. I've been looking at a lot of the Ohio markets. One of the things I've been noticing is in Columbus is actually price strength. So we can see where home prices in the $300,000 range over the last few years. And because inventory is so low in Columbus, we can see that home prices have been climbing since the beginning of the year. We can see, for example, if we switch over here to the inventory number, we can see that, like Baltimore, we have essentially near pandemic lows, and how dramatically inventory is falling in Columbus after the start of the year because people are buying homes. We can see that during the pandemic, late in February was when we hit the bottom. In March, before we start, and you can imagine we've got another couple of weeks before that starts turning up and inventory starts building for the spring season, where there's obviously a lot more activity happening in Columbus. Here's Boise. So Boise was maybe the hottest pandemic boom market in pricing, in price reductions, and then in multiple offers, and then it slowed the fastest. And so one of the things we can do with Boise is you can see how Boise, the market action index was way up here at like close to 100, and it fell all the way back down basically to buyer's market territory, and is now ticking back up because we can see enough demand. We can see tight enough inventory. So inventory in Boise was basically higher than pre-pandemic, just pre-pandemic, although the chart goes back a little further and it wasn't super, super high, but it was higher. And now it's starting to correct back down as demand has returned to the market. We can see in Boise, the $1 million properties taking significantly longer than anything under that in terms of time to sell. And the price reductions was really the big curve we watched here. And you could really see how demand changed. So about 30% of the market we can see in pre-pandemic. And then each of these springs, 13% of the market took a price cut. And then the market slowed dramatically last summer. We had as high as 65% of the homes on the market, 66% with price reductions. That's starting to tick back down and is about bouncing around here. So 42% of the homes on the market in Boise. This is not a hot market. It's significantly better than it was last summer. That's what we know for our sellers. There are opportunities to sell for the properties that are priced right in Boise, but there's nothing in there that's pressuring home prices significantly higher. They're just like, what we know is that it is significantly better than it was last fall, and that's an important message for any participant in that's thinking about joining the housing market. Here's Austin. Austin was the other poster child for the big boom pandemic markets. We can see in Austin dramatic price increases during the early part of the pandemic, and then we are basically flat, down a little bit from last year at this time. You can see the dramatic slowdown in demand there, drop prices down in Austin. We can also see that because inventory is still relatively tight, we're slight seller's advantage. That may not feel true, but last year at this time, this speedometer was floored, and so at 100, and so significantly colder than it was last year at this time. And so we can look at the price range in Austin. Interestingly, the price ranges are not as broad as they are in some of the other markets. The lower end is higher. So the days on market is still very similar across all those ranges. It is interesting to look at the age of the homes that are buying here. They're all relatively new compared to like Columbus or nationally. The bottom market segment, bottom quartile in the national was 63 years. And so it's really a fascinating difference in the Austin market compared to the rest of the country. Here's Tampa. Tampa is one of the markets, as I mentioned. We have price reductions. That's price increases. Let's stick on price increases. Percentage of homes with price increases is an interesting one. This is an indicator of investor demand of fix and flips. It was on the market, it was bought. Now it's back on the market at a higher price. And we could see that during the peak of the investor part of the frenzy, 10%, 11, 12% of the homes in Tampa were like flips. They're back on with a higher price. That fell all the way down to 1% in November, and it's starting to climb back up to a sort of a more normal range. There are people who bought here at the lowest of the demand cycle and now have fix and flip opportunities. iBuyers are coming back a little bit. You can see those things happening in Tampa. And I thought that was a really interesting thing to note. And then let's finish up with Phoenix today. Phoenix is like Boise, ticking up just a little bit on that market action index. We can see that Phoenix inventory is one of those parts of the country where we have significantly more homes than we did on the market a year ago. 200% more homes on the market in Phoenix than we did a year ago. Here's an interesting thing. This looks like catastrophic for Phoenix. But I was looking at this morning, is that a lot for Phoenix? Is 10,000 homes a lot for Phoenix? I did a chart in the advanced analytics page here of this is inventory 2023 versus pre-pandemic for Phoenix. So 2017, 18, and 19. So we have 10,000 homes here on the market now, but in 2017, we had 20,000 homes on the market in Phoenix. So inventory, you might see a headline that says inventory in Phoenix is up 200% over last year. It's still 50% lower than even recent times. And that's the big difference that people need to understand with their headlines and what we're actually seeing in the market. We're also seeing, look at this, Phoenix inventory is falling. This black line here is falling right now, when normally this time of year, inventory is rising in Phoenix. Why is that? Because buyers came back surprisingly quickly this spring. It's a great example of that. I did the same for Dallas too. Dallas down here, inventory is falling when normally it's flat or rising, and we have significantly fewer homes on the market in Dallas than we would normally. Okay, that's all the time we have for the local data today. If I didn't get to your local market, go to altosresearch.com, book a free consult with our team. We can look at your local market and talk to you about how you build your business with the market data. You can use the ebook. It's free. You can get your local reports. Put those in your inbox, but you really want to have the reports in the inbox of your customers, and they need to understand. They need this to be coming from you every week. Okay, that's all the time we have for today. I'll stick around in the chat. I know we've got a lot of stuff in the chat.